shortcut to staying ahead in, well, a truly dynamic world. Today is Monday, September 15th, 2025, and we're taking that deep dive into the financial intelligence brief for yesterday, Sunday, September 14th. Forget just the coffee futures this Monday morning. We're covering the ones that really matter for your portfolio. Our mission today, cut through the noise, bring you the most crucial insights from yesterday's market action and global events. We'll be zeroing in on three major forces really shaping the week ahead. First, there's the anticipation around pivotal central bank meetings. We're talking Fed, Bank of Japan, Bank of England. Second, those escalating geopolitical risks, simmering away in Gaza and Ukraine. And third, the ongoing U.S.-China trade talks happening over Madrid. So as we sort of peel back these layers, here's the central question we're trying to unravel today for you. Are global markets truly showing resilience right now? Or is this calm we're seeing just, the quiet before a potential storm, given these conflicting signals? You've got dovish central banks on one hand and these persistent global flashpoints on the other.
Let's discover what the sources tell us. And to help us navigate this landscape, our intelligence brief today is powered by Nextsight. They're a global intelligence and investigations firm that really transforms raw signals into strategy. They support executives, analysts, investigators worldwide. Insights that are not just reliable, but immediately actionable. Okay, let's start with a global pulse check. Heading into today, September 15th, global markets were largely range-bound. You could almost feel equity investors kind of holding their breath, right? Eyes fixed squarely on those upcoming central bank meetings. Yet, beneath that surface calm, those geopolitical risks just continued to simmer. It's intriguing, this push and pull, this apparent calm, despite some very real anxieties brewing.
It really is a fascinating dichotomy, because while those anxieties are definitely present, U.S. equity indices actually closed the previous trading session, Friday the 12th, near record highs. The S&P 500 rallied, around 2% month to date, and the NASDAQ 100 surged about 3.5% month to date.
Wow.
Yeah, and this was underpinned by, strong rate cut expectations and that seemingly endless optimism around AI. Even the Dow Jones managed a respectable 2% month-to-date gain, helped out by higher energy names. The insight here, I think, is that for now, investors are betting pretty heavily on central bank dovishness outweighing that geopolitical instability.
Right.
They're prioritizing liquidity over maybe genuine stability.
Yeah.
And that's a high-stakes gamble, really, with potential long-term consequences.
That's a powerful observation. So U.S. markets feeling quite optimistic, or at least acting like it. But if we shift our gaze across the Atlantic, the picture becomes quite different, doesn't it? European shares lagged.
Indeed, they did. It really highlights those regional economic vulnerabilities. Germany's DAX, the DE40, was actually down 2% month to date. And that was primarily due to weak German industrial output figures. And then the FTSE 100 in the UK, it saw only a modest 1.3% gain month to date. Strong performance from miners helped offset weakness in those rate-sensitive sectors.
Okay.
So while U.S. markets are soaring on these rate cut hopes, Europe seems, weighed down by the actual economic fundamentals on the ground.
A stark contrast, yeah. And if Europe is showing vulnerabilities, what about Asia? They often march to the beat of a different drum over there.
They certainly do. Look at the Nikkei 225 in Japan. It surged an impressive 3.5% month to date.
Right.
And a staggering 22.4% year to date. This was largely buoyed by expectations, as you mentioned, that the Bank of Japan will maintain its ultra-loose policy. That makes Japanese exports more attractive with a weaker yen, of course.
Makes sense.
Meanwhile, China's Shanghai Composite, despite underperforming slightly on the day, it's still up an impressive 5% month to date. And get this, 43% year to date.
43%? Wow.
Yeah, driven by strong policy support and its own, AI-fueled tech rally. So what we're seeing across Asia is this potent combination of tailored central bank policy and targeted industrial support. It's creating these unique pockets of robust growth, often kind of detached from Western anxieties.
Those are undeniably strong numbers out of Asia. It really makes you wonder how much these regional dynamics will diverge in the coming months. But to truly understand why we're seeing this global mosaic of performance, we need to zero in on those major forces pulling the strings this week. Central banks, geopolitics, trade talks. This week is absolutely pivotal for central banks.
Absolutely. The Federal Reserve in particular is generating significant optimism. The market is interpreting signals that the Fed might finally be ready to signal an end to its hiking cycle. That's at the upcoming FOMC meeting, September 16th and 17th.
Right, the big one.
Exactly. Fed funds futures actually imply around 80 basis points of cumulative rate cuts by year end. But here's the critical layer of complexity, something for you to really consider. There's added institutional uncertainty for the Fed. Yeah, with the potential Senate removal of Governor Lisa Cook and a pending appointment for an open seat. This isn't just, political headache stuff. It's a critical layer of uncertainty that could actually erode market confidence in the Fed's independence.
Interesting.
It makes investors question how reliably future policy decisions will be driven by data alone. That's a major wild card.
It truly is. It shifts the focus from purely economic indicators to the very human and political elements influencing policy. Meanwhile, over Japan, the Bank of Japan have its own crucial meeting on September 17th. We're anticipating a potential, maybe modest, tweak to their yield curve control policy. What might that actually mean for the Japanese yen?
Well, a tweak to yield curve control, even a modest one, could significantly affect the yen. It's benefited from that ultra-loose stance for so long, right? Making the yen a funding currency.
Right.
So any shift could potentially trigger a short squeeze, strengthening the yen, and that impacts global carry trades. It's a very delicate balancing act for the BOJ, trying to navigate inflation while, avoiding an overly strong yen that could hurt their export-driven economy.
Delicate indeed. And not to be outdone, the Bank of England is set to announce its policy on September 19th. What's the expectation there, especially with the UK's persistent inflation issues?
The general expectation is for the BOE to keep rates unchanged this time. The real focus will be on their guidance regarding quantitative tightening, or QT.
Okay, the balance sheet reduction.
Exactly. That's the process where they reduce their bond holdings. The persistent inflation in the UK means their balancing act between controlling prices and supporting growth is particularly tricky. So the pace of QT will signal how aggressively they intend to remove liquidity from the system.
So central banks clearly the main event, setting the tone for market sentiment this week. But like you said, we absolutely cannot ignore the very real, very present geopolitical risks that continue to simmer. Let's start with the Israel-Gaza conflict. The situation has, unfortunately, intensified.
It has. Reports indicate Israeli forces destroyed at least 30 buildings in Gaza City, displacing thousands of people. On the diplomatic front, U.S. Secretary of State Marco Rubio arrived in Jerusalem to meet with PM Netanyahu. This is amid ongoing U.S. pressure on Arab states to, normalize ties.
Right.
The underlying insight here is that this isn't just a localized conflict, it's really a regional powder keg. The direct implications are obvious, the humanitarian crises, but the indirect ones could ripple through global alliances, impacting everything from energy supplies to diplomatic stability across the Middle East. It could potentially reshape trade routes, investment flows.
And we're already seeing some of that diplomatic fallout, aren't we? Arab leaders were quick to condemn the assault.
Absolutely. They've called an emergency summit for September 20th in Doha. And there's a draft resolution for this summit that apparently warns Israel that attacks on Qatar could threaten those normalization efforts. Notably, it also calls for the expulsion of Hamas leaders. This points to a really complex, evolving regional dynamic. These leaders are walking a tightrope, trying to balance internal public pressure with these broader diplomatic interests. The outcome of that summit could signal the next phase of regional engagement or disengagement.
That's a critical development to watch. And then, thousands of miles away, the Ukraine-Russia energy conflict continues.
Yeah.
Ukraine launched a very large drone attack. I think the number was 361 drones on Russia's Kirishi oil refinery. What's the significance there?
Well, the reported damage was minor, according to Russian sources, but President Zelensky stated these attacks are intended to disrupt Russian energy exports. Russia's response was swift, with hypersonic missile tests.
Right.
The key takeaway for you here is that these actions, even if the immediate damage is contained, they highlight the extreme vulnerability of critical energy infrastructure. Any substantial disruption to a major refinery or port facility could quickly tighten global fuel markets, leading to price spikes that impact, everything from transport costs to manufacturing. It's a constant tail risk for global energy.
Definitely something to keep an eye on. Shifting gears slightly, we also had the first day of U.S.-China trade talks in Madrid. These discussions focused on key irritants like the forced divestiture of TikTok and tariffs on Russian oil re-exports.
Indeed, and U.S. Treasury Secretary Scott Bessent signaled that a final TikTok deal was, unlikely before the new October 17th deadline.
Okay, kicking the can down the road again.
Seems like it. And this raises a crucial question for investors. How will the market react to this ongoing uncertainty, especially for major tech players? These digital trade tensions, they could really affect tech sentiment, particularly for companies with significant cross-border operations or, heavy reliance on either market. It just adds another layer of regulatory risk to an already complex sector.
Okay, that gives us a clear picture of the major drivers. Now, let's dive a bit deeper into how all these factors, central bank anticipation, geopolitics, trade, are actually translating into asset class performance. First up, rates and credit.
Right, so rates markets clearly reflected that optimism for a dovish Fed we talked about. The U.S. 10-year Treasury yield settled near 4.07% on Friday, September 12th. The 2-year was at 3.56%, the 30-year at 4.68%.
Okay.
And those Fed funds futures, as we mentioned, imply substantial cumulative cuts by year-end. But contrast that with Germany's Bund 10-year climbing to 2.71% and the UK gilt 10-year reaching 4.68% amidst that persistent inflation. Japan's 10-year JGB yield also edged up slightly to 1.60% as traders anticipate that BOJ tweak. The insight here is really that different regions are experiencing distinct inflationary pressures and monetary policy expectations. It's leading to this fragmentation in bond market performance.
So divergence in bond market narratives. What about volatility in credit spreads? Are investors getting complacent, or are they pricing in more risk?
That's a critical question, isn't it? Equity volatility, the VIX, remained relatively depressed around 14.7. That suggests a degree of market calm, maybe complacency. Bond volatility, the MOVI index, also slid to 73.37, and credit risk premia were contained. The ICE BOFA U.S. investment grade spread was at 0.78%, high yield spread at 2.78%.
Pretty tight.
Very tight. This indicates a supportive environment for credit. For now, tight spreads suggest investors aren't demanding a huge premium for risk. However, you could interpret this as, a certain level of complacency, given those geopolitical risks we just discussed, aren't really translating into wider risk premiums yet.
That's good news for credit, at least for the moment. Moving over to foreign exchange or FX markets, they were relatively quiet, weren't they?
Mostly quiet, yes. The EUR-USD cross hovered near 1.173, basically unchanged. USD JPY was around 147.7, reflecting that clear policy divergence between the Fed and the BOJ we keep mentioning.
Right.
GBP USD firmed slightly to 1.356 after some stronger UK economic data came out. And China's USD CNY midpoint strengthened a bit to around 7.102 as authorities maintained a relatively strong fix. The DXY index, the dollar index, also slipped about 0.1% for the week, maybe suggesting fading U.S. exceptionalism.
So what's driving these relatively stable FX markets right now, and what could actually shake that stability up?
Well, FX markets are keenly focused on two things coming up, U.S. CPI data and that FOMC guidance. A more dovish Fed could definitely put pressure on the dollar, potentially weakening it against other major currencies.
Okay.
Conversely, any surprisingly hawkish commentary from the Bank of Japan, especially around yield curve control, might prompt that short squeeze in the yen we talked about, pushing its value higher. In Europe, the ECB seems to have concluded its hiking cycle, and that's effectively capping any significant upside for the euro, keeping it pretty range-bound for now.
Okay, let's talk commodities. Energy first. What's the picture there?
Right. WTI crude was trading around $62.56 per barrel. Interestingly, still down about 8.9% year-to-date, despite stronger U.S. demand and OPEC discipline. Brent hovered near $66.81 per barrel. Natural gas at $2.96 per MMBtu, that's million British thermal units. And gasoline at $1.9098 per gallon.
Okay.
The latest EIA weekly petroleum status report, that's the U.S. government data for the week ending September 5th, it showed some notable inventory builds. Crude inventories up 3.9 million barrels, gasoline stocks up 1.5 million, distillate stocks up 4.7 million barrels.
So building supplies.
Yeah, which is good news. It means we have a healthy supply buffer, helps ease any heating oil concerns as refineries typically go offline for maintenance in the autumn. Natural gas storage also rose by 71 billion cubic feet to 3,343 BCF. That remains a healthy 188 BCF above the 5-year average.
That's a lot of reassuring inventory data, especially with winter eventually approaching. What about precious metals? Gold's been making headlines, flirting with new highs.
It certainly has. Gold, at $3,648.55 per ounce, was indeed flirting with all-time highs. Falling yields definitely increase bullion's appeal as an alternative asset.
Right, opportunity cost.
Exactly. But the curious thing here is that this also points to increasing safe haven demand in the current climate. It reflects that underlying investor anxiety, even while equity markets are high. Silver around $42.18 per ounce, and copper at $4.58 per pound also remain firm, indicating pretty broad-based strength in the metals complex.
Moving into the digital realm now, how did digital assets perform on September 14th? Are they still seeing that momentum we've talked about?
Digital assets remain firm, yeah. It signals continued institutional interest, it seems. Bitcoin traded near $115,891 and Ether around $4,619 on September 14th, according to Trading Economics.
Still very high levels.
Very high. Both tokens have seen significant year-on-year gains, roughly 99%. That's driven by mainstream adoption and those ongoing ETF inflows. It really speaks to a maturing market, although, it still remains highly volatile and very sensitive to macro liquidity conditions. The narrative of digital assets as a legitimate, albeit speculative asset class, it just continues to gain traction.
And finally, let's touch on real estate and housing. Any new developments there, especially thinking about mortgage rates?
We did see some encouraging signs in the U.S. housing data. Mortgage rates eased a bit. The 30-year fixed rate fell 15 basis points to 6.35% for the week ending September 11th.
Okay, decent drop.
Yeah, it was the largest weekly decline in a year, actually. And it's supporting signs of stabilization in housing demand. It implies that even a modest reduction in borrowing costs can inject significant life back into the market. And beyond the U.S., Canada actually launched a $13 billion national housing agency. They're trying to accelerate affordable housing development and address those structural supply shortages. It shows governments are focusing on these persistent issues.
Okay, that gives us a truly comprehensive picture of the market's inner workings. So, beyond all these numbers, let's bring it back. What are the key trends and upcoming catalysts we should be watching? What does this all mean for you and the week ahead, especially regarding our central question about market resilience?
Well, looking at our key drivers, monetary policy is clearly front and center. Central banks are shifting from hiking to holding, right? The Fed's expected to signal an end to tightening. However, risks remain. Unexpectedly strong inflation could prompt renewed hikes. And that institutional uncertainty at the Fed we discussed, including potential political interference that could significantly politicize policy decisions.
Right.
That's a medium-level risk, I'd say, but with high impact potential this week, especially concerning investor confidence in policy independence.
That potential politicization is a huge concern, yeah. Threatens the very credibility of the central bank. And then there's geopolitics, which just seems to keep escalating, doesn't it?
Absolutely. The Israel-Gaza conflict, Ukraine striking Russian infrastructure, persistent U.S.-China tensions, they all contribute to what we'd assess as a high impact potential. A wider regional conflict or a significant escalation could disrupt energy markets, bring sanctions risk, lead to trade restrictions. It raises serious tail risks across the board. The current market calm feels somewhat at odds with the severity of these potential outcomes.
It does feel a bit strange. And those energy markets, while contained for now, seem particularly vulnerable to sudden shocks.
They are. Oil prices are contained, yes, despite OPEC discipline in building U.S. inventories. Natural gas storage is also above average. However, severe weather events, Middle East supply disruptions, unexpected refinery outages, any of those could quickly spur price spikes. It's a medium risk, balanced in the short term perhaps, but highly vulnerable to those geopolitical shocks that can appear seemingly out of nowhere.
Okay. And housing. We saw near-term improvement from lower rates, but those structural supply issues like the ones Canada is trying to address, they persist.
Yes, housing feels like a lower-level risk for now. Short-term improvements provide some stability. However, a significant rise in long-term rates or a broader economic recession could quickly derail any recovery. And those structural supply issues, they'll continue to be a long-term challenge, impacting affordability and growth potential for years.
Right. So wrapping up then, what does our catalyst calendar look like for this week? What are the absolute must-watches that could really shift the narrative?
Okay, the calendar is packed, and it speaks directly to our theme, central bank influence versus that geopolitical backdrop. So September 16th, Tuesday, we get the U.S. Consumer Price Index for August. High importance inflation gauge will definitely shape FOMC expectations.
Crucial number.
Crucial. Then immediately after, September 16th and 17th, it's the Federal Reserve FOMC meeting itself. Very high importance. Market expects no hike, expects dovish guidance. So we'll be watching the statement, the dot plot, very closely for any surprises that challenge that narrative.
That Fed meeting is going to be huge, no doubt. And the other central banks you mentioned earlier?
Right, so September 17th, Bank of Japan policy meeting, high importance. Potential tweak to yield curve control could affect the JPY. Also on the 17th, U.S. retail sales for August come out. Medium importance indicator of consumer resilience.
Right?
Then, September 19th, Bank of England monetary policy announcement, high importance. We're looking for guidance on QT there. And finally, September 20th, that Doha Arab Islamic Emergency Summit, high importance, discussing Israel, Gaza, potential diplomatic or even economic fallout.
It's a packed agenda indeed. It just demonstrates how interconnected these global financial and political landscapes really are. We really covered a huge amount of ground today, haven't we? From U.S. markets near record highs to lagging European equities, strong Asia, divergent bond yields, crypto momentum, crucial updates on energy, housing. It feels like markets are caught between genuine optimism and some really significant lurking uncertainties.
Precisely. And understanding these interconnected threads is just crucial for staying ahead in such a dynamic world. The interplay between monetary policy, these escalating geopolitical flashpoints, and those persistent trade tensions. It isn't just defining the market landscape, it's shaping the very definition of market resilience right now.
So, what does all this mean for you as you navigate this complex week? Maybe consider this provocative thought. How will this week's pivotal central bank decisions, particularly from the Fed and the BOJ, truly reshape global market sentiment and investor confidence, especially when viewed against the backdrop of escalating geopolitical tensions? Is the current market calm a sustainable foundation, or are we witnessing a fragile equilibrium that could quickly tip? That wraps up our deep dive into the Sunday, September 14th, 2025 Intelligence Brief, delivered to you on this Monday, September 15th. Don't forget to subscribe wherever you listen. Drop us a like, a share, maybe a comment. We'd love to hear your perspective. May your Monday be as insightful as it is smooth.